Hi traders, I'm Ross Maxwell and welcome to the latest edition of the Keyzone Traders Trade of the Week. So, have you ever been stopped out of a trade only for the market to turn around and go straight to your target? I'm sure any trader that's been trading for any amount of time has experienced this and know that it's one of the most frustrating things that can happen to you as a trader. Well, this week's review is a bit about how you can actually identify that to reduce the chance of that happening, but not only that, also use that to your advantage to make more opportunities for you in the market. So if that's ever happened to you, I'm hoping you're going to find this useful. Let's go take a look. Hi traders, so this week we're going to look at a trade in the Aussie dollar that we took, and again this isn't necessarily the best textbook setup, but it does teach a good lesson about the sorts of things that you should be looking for and thinking about when you're deciding and selecting the trades that you're taking. So a lot of retail traders, they will take a signal. And if you've been a trader for a while before, you'll know that quite often one of the most frustrating things as a trader is for you to get stopped out on a trade and then the market turn and go and do what it wants to do. Now, this is all part of the market function. The reason it happens is part of market function, which I'll go into in another lesson, another session, another day. But what you want to be doing is, and what happens is a lot of retail traders then moan about their luck. They moan about the institutions playing with the little guys and taking advantage of them, and think that they can't beat them because they've got so much power that they can actually do these sorts of things and affect your trading. But what you need to do there is think, right, okay, well if I know that happens, that's information that I can then use in my trade selection. I know that a lot of retail traders, they get stopped out and then the market will go and do what it wants. So, with that in mind, let's have a look at a trade that we took this week on the Aussie dollar. It was a 15-minute chart that we actually traded this on. And I'll tell you the exact thought process which links into what I've just been discussing about. So, this candle here, so you've got this nice impulsive move down, a corrective move back, and then this candle here is a reversal pattern. It's a pin bar that most people will know about. It closes on its lows. It's in the face of that big move down, extended on the Bollinger Band. So this trade breaks down and people get triggered in, and it moves down and it starts working quite nicely, and then all of a sudden, bam, moves up. Would stop people out who have their stop just above this reversal bar. And then it goes and does exactly what it wants. So what's actually happening is retail traders get into this reversal signal. They have their stop just above here. They get stopped out. The institutions go stop hunting, clip them out, and then it goes and does exactly what they wanted. So how can we use this information? Let's drill down and look at this on the 15-minute chart as to what we saw. So you have, this is where it, on the 1 hour chart it triggered in. This is the move down where it was all looking great. The retail traders got in here, moves down, looks great, and then bam, takes them out. But what does it do? Actually puts in a 15-minute reversal candle here, which then is the signal. So for us, what we're looking at here is we're sitting there saying, okay, well, we've got a sell signal. Has it taken out some obvious stops? So has it taken out a previous swing high? Because if it's taken out some swing high, it's caused pain to some people. Other people will want to get back in, and that will add weight to our trade. So what we've done is we don't take that first signal. We don't take the one where most retail traders get in. We wait to see and look where the market may have taken stops and then reversed to go and do what we expect it to go and do. Now, this doesn't work every time. Sometimes we are still the ones then go and get stopped and it goes and does what it does. But by looking for that signal, where and adding that little bit of context into it to look to make sure or to see if there's been some stops taken out before we enter the reversal, we increase the probability of our trades going on to work and us not being the one who gets stopped out. And this one actually really tied in nicely as well, because if we just draw a line across here, you can see that it was actually ended up, it was support over here as well, and support here, and then it come and retested that level here. So it was a breakout and then a retest of the level, having taken out some stops from that hourly reversal before going and taking and working. So that's the trade that we took and we're reviewing today. Now, so I hope you find that useful, and actually we missed this trade, but we did spot it afterwards, and it done exactly the same thing the following day, a little bit later in the session, but still on the same thing. Put it in a reversal here, moves down nicely, big spike up, just takes out the stops here, puts in another reversal, and then moves on down. This one didn't have quite the move down, but you definitely would have been able to get 1 to 2R out of this one. Here it worked quite nicely before. You know what? Taking out the little low there, the stops, and then moving up. It happens all the time. So look for those areas. So when you're entering a trade, especially on reversals, not necessarily on breakouts and things like that, but when you're looking for reversals, look to see if you can see a place where the market may have just triggered some stops and then reversing to get back into the market. So I hope you found that useful. It's a really good tip to take on board into your trading, and I'll speak to you next week.